Similar to the pay statement, which is often tossed aside, since most documents have become paperless over the past decade, the mortgage statement is not commonly reviewed each month. Although a mortgage statement may seem dull and solely quantitative, it can reveal a unique story, plus opportunities for deeper conversations as a family that go beyond the numbers. During this lesson, we will review a real mortgage statement, and if you currently have a mortgage, please download your most recent statement to follow along in real time. At the top of the statement, we find the mortgage servicer's contact information, the statement date, the property address, and the homeowner's name and mailing address. Even if you jointly own a home with your spouse or partner, the mortgage lender may have only considered one person's financial information during the underwriting process. Also note whether your listed name matches your home's titling on your county's appraisal district website, which could be owned individually, jointly, or in the name of a trust. You can submit updates such as a name change if you and your spouse bought your home together before marriage, for example. The mortgage statement date, commonly called the statement closing date, is when the monthly interest charges are calculated, whereas the payment due date often falls 20 to 25 days later. When we enter the statement information into our debt repayment calculator, we will use the statement date, shown here as December 4th, 2023, with the payment due by the first of the following month. Moving to account information, the outstanding principal balance is the remaining loan balance as of the statement date. And since interest accrues over time, the actual payoff amount will differ from the outstanding balance shown and must be requested by contacting your mortgage service. When the mortgage is fully paid off, you will receive a loan payment confirmation letter. At that point, you'll have 100% equity in your home, but will continue paying those home-related taxes and insurance out of pocket. The maturity date is when the mortgage is expected to be fully repaid if only making minimum monthly payments. As we'll see on the debt repayment calculator, making additional principal payments may satisfy the loan much earlier than the date shown here. The interest rate is the annual cost of borrowing. This percentage is divided by 12 months and then multiplied by the outstanding principal balance to determine the portion of your monthly payment allocated to interest versus principal. This amazing fixed interest rate of 2.875% is divided by 12 and then multiplied by $492,374.59 to arrive at the interest payment for this statement period, $1,179.65. As a sidebar, here is a visual breakdown of a 30-year, $350,000 mortgage with a 3% fixed interest rate. Since the outstanding principal balance is naturally largest at the beginning of the debt repayment period, more than half of the loan's total interest is actually paid within the first third of its life when paid minimally. In this example, we notice that the principal portion of the monthly payment does not exceed the interest portion until the beginning of the 8th year. Although paying interest can be a bummer, at least this fixed mortgage payment is a hedge against future inflation, effectively making the payment feel less costly over time. As we previously calculated, each monthly mortgage payment covers a portion of the loan's principal and interest accrued since last month's statement, with only the principal amount reducing the outstanding loan balance as it nears the maturity date. We notice on this statement that Susan also makes monthly payments into an escrow account, which is essentially a forced savings account that allows the mortgage lender to disperse their property tax payments and home-related insurance payments on their behalf. If you make escrow payments, keep in mind that they are estimated, and you may owe more or less when the actual tax and insurance bills arrive, called an escrow shortage or overage. Government-backed FHA and USDA loans require an escrow account, whereas conventional loans may have unique requirements per mortgage servicer. Some homeowners prefer to save for these expenses themselves and earn interest along the way, while others like the forced savings to avoid surprises. Either way, funds anticipated to be spent within 1 year have an investment objective of stability and liquidity, and I don't like to commingle these funds with the emergency fund, since they are anticipated expenses, not a surprise. For additional clarity regarding your property taxes, you can look up your tax payment history by initiating a property search on your county's appraisal district website, where you can also review your titling information as mentioned before, land versus home site values, appraised versus assessed values, and current exemptions and propositions. You could learn something about your home's history that you didn't even know. My wife Marissa and I found out that our backyard used to have a pool. How did we miss that? Combining the monthly payment amounts, principal, P, interest I, taxes T, and insurance I, also known as PITI, multiplying by 12 months per year, then dividing by gross household income, you can calculate the well-established housing debt-to-income ratio. I encourage you to establish your own debt-to-income benchmarks as a family. For example, since my family values cash flow flexibility, we prefer to keep total debt payments, housing and otherwise, below 20% of gross income, well below the industry benchmark of 36%. For us, that means a combination of living in a low cost of living area, choosing a 30-year mortgage, and keeping household income above $80,000. Establish and track your own metrics of financial health, going beyond rules of thumb. Although not seen on this statement, you may find that the mortgage lender also requires private mortgage insurance, PMI payments. If you have a conventional loan with less than 20% home equity, you may request an inexpensive external appraisal from your loan servicer to reevaluate your home's value, especially as house prices have increased significantly over the past few years. This simple action may save thousands of dollars worth of future PMI payments. At the bottom of the mortgage statement, we can see the payment history, including whether additional principal payments have been made or late charges have been issued. We notice that this family prefers to round up their monthly payment to $3,700, which will actually reduce their repayment period by 17 months and total future interest by nearly $13,000. Consider your and your family's unique debt repayment philosophy before making any changes to your implementation. We'll discover that every financial decision involves personal preferences. As you review your mortgage statement, you can use the debt repayment calculator to discover additional planning opportunities. Referencing the mortgage statement, we enter the outstanding principal balance, annual interest rate, minimum monthly payment, which combines the principal and interest amounts, not including escrow, additional payment intervals for a range of repayment options, the current month, where you can use the mortgage statement date, and the owner's birth month. Given those base facts, the results provide the monthly and annual payment amounts, the future interest paid or saved by making additional principal payments, the next 12 months' interest to provide insights into possible itemized tax deductions, how many years of repayment remaining, the month and year of anticipated repayment, and the owner's age when the debt is fully repaid. The annual payment provides insights about your fixed, non-discretionary cash flow needs, and a portion of this may be included as part of your emergency fund, adding back in the homeowner's insurance premiums and property tax payments. You will notice the concept of thinking about your money in terms of time reiterated throughout this course, from both investment and debt repayment perspectives. When you visualize the year and age of repayment for various liabilities, you may be surprised or relieved, depending on how it fits within your overall financial landscape. You can use this debt repayment calculator for any type of debt, not just the mortgage. Mortgage repayment is a great conversation starter to consider quantitative variables such as the timing of debt repayment with retirement income distribution needs or its alignment with other events such as claiming Social Security. For example, many people want to be completely debt-free by a certain age or before their anticipated retirement date to reduce future cash flow needs, and this calculator can help you visualize that decision, whether rational or reasonable. Consider to pay off debt more aggressively or use current cash flow for other spending, savings, and investment objectives. This topic of debt repayment goes beyond interest rates and investment returns, and we'll cover more strategies during the credit card lesson.